Please read the risk warning carefully before we start. Today we will be speaking about the Japanese candlestick patterns. At any time, if you have any issue, if you need any clarification, any issue with voice or screen, please send me on the chat. Okay, let's move on. So before we dive into the Japanese candlestick patterns, let's very quickly remember the types of chart we use to record the price action. So we have three types of charts. You can see now the three types on your screen. This is a line chart. Let me use this laser pen. Okay. There is a line chart. This is the candlestick chart. This is a bar chart. I will quickly review them one by one. So this is the line chart. This is a chart which represents a connection between the closing prices within a line. So it shaped this line chart over a set of period. Like this one is 1 hour chart for the dollar yen. So each dot here represent closing price for 1 hour. Okay, this is the most simple way to see the prices. Now we will move on to a bar chart. This is more advanced. It displays the open, high, low, and close prices for each period. For example, if you can see this green bar, the price on the left, this is the opening price. This on the right is the closing price, and this is the wicks or the shadows are the highest and lowest price during the period. For example, if this is a day, so during the day this will be the highest and the lowest, and vice versa. For the red bar, it will be open price. This one will be the closing price, and of course, because it's going down, this is the lowest point, this is the highest point. As you can see, the bar chart give more information, but it take some time to translate this to actual actionable decision. So we developed this to the candlestick or the Japanese candlestick chart, which is just like the bar chart, but with the visual representation that show a body of the candle between the open price and the close price. And we distinguish between the up and down candle by using different colors. There is green and red, as you can see here on my screen. Also white. It can be instead of green for up candle, and black can represent the same as red, which represent the down candle. So also in any chart application, you will have the option to change this to other colors, like some people use blue instead of green. So you can change it, but the classic chart has the white for up and black for down. So for example, if you hear like the Black Friday, they meant it was going down, very down. That's why it's called black. So and now we have the green and red. This is also very common. So what is a candlestick? A candlestick is a way of displaying information about an asset or currency or a metal or a share. So it's a price movement. Candlestick charts are one of the most popular components of technical analysis, enabling traders to read price information quickly. This is the most important thing about candlestick. It makes you read the price quickly. I told you in the first slides that we have line chart, we have bar chart. This takes time to read, but candlestick charts is very quickly giving you information, and from just few price bars you can see the movement. So it has three basic features. At any time, if you have any issue, if you can see my screen, if you have any issue with voice, please send me on chat. Also, if something is not clear, I think everything is going well. Okay, let's move on. So the candlestick has three components. First is the body. If you can see my laser pointer, this is the body, which represents the open to close range. This is a green candle, so it represents going up. So it starts here. This is the open price, and the close price is here. So this body is green because this is a up candle, and this one is red because the open is here. The price went all the way down to here and closed this way in a down move, so it become red. So if you see this candles without colors, you wouldn't know. So the color actually give you, as we mentioned, we need quick information. What happened? So you see green or white or blue, whatever color you choose, but you should keep some color so your eye and mind just make the connection. So you see, whenever I see a green candle, I know it's up. Whenever I see a red candle, I know it's down. And this is like universal, white and black also. So we have also the wick, which this shadow, you know, this is the highest point and this is the lowest point of this candlestick. The candlestick can represent any period of time. So this candlestick can represent a day, like traditionally the classic candlestick was just for a day or 4 hours. And then when we advance, we have like even you can have 1 minute candle or even less. So the wick is the high and low point during the candlestick period, and the high is above the closing for the green, and the low is below the open for the green, and the low is below the close for the red candle, and the high will be above the open of the red candle. So now we have the body, we have the wick, and also we have the color, which reveals the direction of the market movement. Green or white, this body indicates a price increase, while a red or black body shows a price decrease. As I mentioned, you can change these colors, but it's recommended to have to determine one color and keep it for all your technical analysis. So you can read quickly. So over time, individual candlesticks form patterns. Traders can use these patterns to recognize major support and resistance level. There are great many candlestick patterns. There is a lot that indicate the opportunity within a market. So some provide insight into balance between buying and selling pressure, while others identify continuation of the trend of the market indecision before it starts trading. So it's important to familiarize yourself with the basics of the candlesticks patterns and how they can inform your decisions. So today we will have some of the most common candlestick patterns you can see. So we will divide this to 3 patterns. We will start with bullish candlestick patterns. When we say bullish, we mean like the bulls or the buying power are dominant in the market. So bullish patterns may form after market downtrend, and it signal a reversal of the price movement. So they are indicator for a trader to consider opening a long position to profit from any upward move. So the candlestick patterns I will explain right now. This is for a bullish candlestick patterns. Okay, at any moment, if there is any issue, if there is any question, please feel free to send me on the chat. So this is now the first candlestick pattern we will start. If you just joined us right now, you didn't miss much. We just said that we have 3 kinds of charts: line chart, bar chart, and candlestick chart. And today we will talk about the candlestick chart, and we'll speak about the candlestick patterns. And now we will start with the bullish candlesticks. When you see this, this means there is a buying power dominant in the market. So typically it will be in a downtrend. So this is a reversal for the trend, but it will mean the bullish power, the buying power is very strong. The hammer. This is, I think, the most known candlestick pattern. I think everyone who has any trading experience would know about the hammer, or at least you can see it. This is the hammer. Probably you saw it before, but maybe you don't know it's the hammer. So the hammer candlestick, it's formed of a short body. As you can see, this is very short. The open is here, the close is here. And there is a long wick. This is in a bottom of a downtrend, as you can see. So there were selling pressure. I want you to imagine how the hammer were formed. The open price were here. The downtrend is very strong. So if this is like a 1 hour chart, this candlestick for like maybe for 40 minutes was a very strong red candle. Then buying pressure drove the price back up, and also it drove it above the opening price. So if the color of the hammer is green, this is a stronger indication that the buying power is very strong. If it's a red hammer, yeah, it's still a signal, but the green hammer is a very, very strong signal. So you can buy from here, from the closing price, and you can put your stop loss under the wick of the hammer. So let's move on to the inverse hammer. Okay, I'll give you something of a hint. I will tell you a lot of candlestick patterns today, but the whole process of reading a candlestick is trying to understand what's the market is telling you, what's the price action is telling you, because what's shaping these candles actually is real people like you buying or selling. There is fear of losing, there is greed of more profit. So you can see this as a scene, as an article, as words describing what's happening in the market. Don't look just to it is like price moving up and down. No, no, no. You have to understand what's happening in the market. Here, imagine with me what's happening. We are in a very strong downtrend. Most traders follow the trend. So most traders are just selling or waiting for correction to sell, like this candle. Okay, then at this moment we opened, the price was here, is a low. This is a low, a new low, and then the price moved all the way up to here. Then it went down, but it couldn't go below the opening price, and the close was above the opening price. So this story tells you that there is a strong buying pressure, and this downtrend might not continue for a very long time. So you can here consider a buying position from this closing price, and also you can put your stop loss below the wick, not at the wick, because sometimes the price just go and test it and go up. So below it for like some pips. This is the inverse hammer. It's the same as the hammer, but it's inverted. Let's move on. At any time, if you have any question, please feel free to send me. I'm going quickly because I still have a lot of patterns and I want to keep you updated with all the patterns. So this is the bullish engulfing. This is one of the strongest signals. What you can see here is a downtrend. As I said, all this 70 or 80% of time you will see it in a downtrend, because this is like a reversal pattern for a bullish momentum. The bullish engulfing is started with two candles. It started with a red body candle, which is completely engulfed by a larger green candle. Try to understand the story. Don't just look at the candles. What you can see here is downtrend, red candle, so it's just moving in the direction. Then the open and the close, this is increasing. This is exceeding all the body of the red candle. So this is telling you what, yeah, the buying pressure is very strong. So it engulfed the last candle. And actually, when you have this wick, this tail didn't exceed the price of the wick of the above candle or the last candle, this is stronger confirmation. So you can have a buying position from here and put your stop loss below this area. I always say don't put your stops exactly on the wick, because most of the time the price will just test this area before it go. So just make it a little lower, give the market some, some breathing space. So this is the bullish engulfing. And then we will have the piercing line. It's a very strong red candle. This is combined of two candles, just like the last one. So we have a red candle, very strong red candle. And then you know what's happened between these two candles? This we call gap. The gap happened when the market moved very fast between the closing price of the last candle and the opening price of the new candle. So it doesn't give the market a time to shape this movement in this candle or this candle. So we have this gap. And then we say we have the, like, it's not a rule, but most of the time the market will go and close the gap. Most of the time will have this candle, will have this closing gap. This candle, this green candle, goes to 50% of the red candle. So after this move, we have now predicted that the bullish momentum is very strong. Okay, you understand? I'll give you a minute. If someone has any question, please feel free to send me. So I think everything is going fine. As I mentioned, now the price moving down, then a gap, then the price moved up, closed the gap, exceeded the 50% of this red candle, and this indicates the market will go up. You can open a long position here and put your stop loss below this wick. So now we will go to the morning star. This is also very popular candlestick pattern. We need 3 candles actually to have this shape. We need 3 candles. As all these 6 patterns, we have downtrend. All the bullish patterns happen in a downtrend because it's a reversal. So the downtrend is going down. We have a very, very strong down candle. This is a very strong. Then we have this small body with short wicks. So this is the star. It should not overlap with the longer bodies of the last candle and the second candle. So after the star, we will have a strong green candle, and then after this green candle, we will have the confirmation. From this candle, we should buy, not from the star, from the green candle. That's confirmed that this is a morning star. So we have a pressure, we have a movement, a strong movement of the buying, demanding the market to go more higher. So we start the position from here and we put stop loss under the wick of this candle. Okay, now we will have the 3 white soldiers. So 3 white soldiers start from a downtrend. Then you will have 3 candles with very short or even without any shadow or wick. It's just a body. And the 3 candles are moving in the direction of the buying, the bull market, after some bearish or selling pressure. So 1, 2, 3. Each candle start open and close above the previous candle. So this one started here, closed here. This one started here, open, and closes here. The third one actually does not have any wick. It's complete body, open here, close here. This is a very strong bullish momentum candle, and you can start buying from here. You should put your stop loss below this first candle. So this is the 6 bullish candlestick patterns. We have the hammer and the inverse hammer. We have the 3 white soldiers we just had described. We have the piercing line. We break the 50% of this candle, and we have the morning star we just described, very red candle. then the small body candle, then a very strong green candle, and then we have the bullish engulfing, which is two candles. One is red and one is green, and the green engulf all the body and more, close above the price, and typically it will close above the highest price. You can have this as the reference at any time to make you remember. By time you keep seeing this pattern, so you just you see it, you keep it in your mind many times, and then you recall it anytime you need. So let's move on to the bearish candlestick patterns. Before I move on, if there is any question, please feel free to send me. If you have any issue with voice, or if you have any question, just send me. Seems like everything is going fine. I will have time for question at the end of this webinar, and also we will have some actual live market examples. So the bearish candlestick patterns. Okay, this is when the opposite of what we just saw. We have a market which is going up, and then we have a resistance point. So here comes a heavy selling pressure, often causes traders to close their long position and open a short position to take advantage of the falling price. They say that sometimes, or most of the time, that moving down happen faster than going up. Maybe okay. Sometimes, most of the time, this happen. So this bearish move sometimes will happen even faster than going up. But actually, the real rule here should be that the reversal happens very fast. So if a market is moving in a trend, the trend is making it's an uptrend, is making newer highs. Sometimes, or most of the time, it will happen slowly. But when there is a reversal, it happens very fast. So if it's an uptrend, the going down happen very fast. So we start with the hanging man. If you recall the hammer or the inverse hammer, this is the same. But what's the difference? The difference is we see this in an uptrend. So you need always to be aware of the trend, where the trend is going. So you can understand the candlestick patterns, you have to know where the trend is going. So this is an uptrend, very strong uptrend. Okay, the price started here. This is the open price. It went all the way down. It mostly almost touched the open price of the last candle. Then there were the bulls trying still to win the market. They pushed the price up, but see here what's happening. The closing price is still below the opening price. It's a red candle in a very strong uptrend. So this gives you an indication that the bulls are losing power and bears are taking the steer, and maybe the market is changing direction. So you can sell at the end of this the closing price and put your stop loss at above the wick. What I like about this, whenever I have a candlestick pattern with a very tight stop loss, I like it. I take the chances. So it's like very low risk. Even if it's loss, it will be a very low risk. So let's move on to the shooting star. Now we have the body down and the wick or the tail up. So as I mentioned in the first minutes, you need to understand what's happening. Don't just memorize the candlestick patterns. Understand. So it will be like second nature for you to understand what's happening in the market. The market went all the way up in a very strong uptrend. Then it went all the way down and even exceeded the open price, which was here, to lower price, which was the closing price of the previous candle. So you can open a short position here and you put your stop loss above the wick. This will have bigger stop loss than the last candlestick pattern, but it's a very strong pattern. So whenever you see it, actually the shooting star is like very strong candlestick patterns. You can sell. Of course, you should keep this with other technical and fundamental analysis, but by itself is a very strong bearish candlestick pattern. Then we have the bearish engulfing. If you recall the bullish engulfing, this is actually the opposite. So we have an uptrend, we have a green candle, and then we have a strong red candle that exceed the open price and the closing price of the green candle. So this is an indication that the market might change direction. So you can sell from here and put your stop loss above the wick or the tail of the candlestick. Then we'll go to the evening star. This is the opposite of the morning star. So it's like three candlestick pattern. We have a green candle, we have an uptrend, and then we have this small body evening star. And then we have a red candle at the opposite direction. So now we will have the confirmation from the third candle. This is the evening star. When this red candle close, and typically it will be very near to the opening price of the first green candlestick. So we will open the short position from here and we will put the stop loss above the evening star. Let's move on to the three black crows. This is the opposite of three white soldiers. This is we call it black or red because this is a down move, a very strong uptrend. Then we have candles that typically has no tails, no wicks, or a very short wick like this, and every candle open and close below the previous candle. So this one open here, close here. It does not interfere with the previous candle, and then the last one does not interfere with the middle one. So we have now this confirmation. After the third candle, we sell and we put our stop loss above the first candle. So as you can see, now we have the dark cloud cover. This is, it's not very complicated, okay? Just focus on it. You have strong uptrend, you have this green candle, and then you have this gap where the market gap strongly move up. For some time it move up, but then it failed to continue the move in the uptrend. Remember that this bearish candlestick patterns has to be in a very strong uptrend. So the market moved all the way down, and actually the wick exceeded the open price, but then went up for some time. So the closing price here is below the closing price of the previous candle, and then we have a confirmation. The confirmation should be that the closing price of the third candle is not exceeding the closing price of this red candle, or even the 50% of it. So now we can sell and put our stop loss above this wick. Here you go. This is the 6 bearish candlestick patterns. This is the hanging man. It's opposite the shooting star and the bearish engulfing, which is like green candle, and then followed by a red candle, which engulfed the whole of it. Dark cloud cover, we just described all the information about it. Typically, the confirmation candle should not exceed 50% of the red candle, and then the 3 black crows, typically each candle should not cross the open and close price of the previous candle. And the evening star, it's a 3 candles, green, and then the small body, and then the red. So it gives you indication of reversal pattern. Let's quickly go to continuation candlestick patterns. This indicates that the market is not changing. So we started with bullish, which bullish candlestick patterns that occur in a downtrend. So it reversed to a bullish trend. Then we had 6 patterns that happen in a strong bullish and change it. Now we will have a continuation pattern. When we see this, the market most of the time will continue the trend. We will start with the doji. This is very common. You see, typically it wouldn't be a big body. It should be a very small body. And if the opening and closing price is the same, so this is a typical doji, and the tails should not be very big as well. When you see this, this is a market indecision. The market is not does not know where to go, so most of the time the trend will continue. This is the doji. And then the spinning tops. This is just like the doji, but with bigger body and bigger wicks, bigger tails. But most of the time when you see this, the market will continue in the same direction. Let's go to the falling three methods. This is in a downtrend. We have a big red candle, and then we have three candles. All of them couldn't exceed the opening price of this red candle. So 1, 2, 3, and now the price could not exceed it. So now we predict the market will continue in his downtrend. We have the opposite, which is the rising three methods. We have a green candle here, 1, 2, 3, three candles trying to break, but it couldn't. So most of the time we can continue with the trend. So we can open buying here, and the position should have stop loss above, below this candle. So this is the rising three methods and falling three methods, doji and spinning tops, which is the continuation candlestick pattern. So when using any candlestick pattern, it's important to remember that although they are great for quickly predicting trends, they should be used alongside other forms of technical analysis to confirm overall trend. And actually, with the fundamental analysis as well, this would be my recommendation. So if you have any question, feel free to send it right now. Okay, let's move to the actual market to see this. This is a daily dollar-yen candlestick. You can see here, this in a very strong downtrend. We had this hammer. The market, if we can open a long position from here and put that down from here, the market's actually moved for like 5 or 7 days above the lowest point, and we can make a very good profit with this. You can see here, this is a bearish engulfing. You see, well, I'm not trying to mimic the pattern. I'm not trying to get it like exactly like the book. I understand what the pattern is doing. So this one, it's a green candle followed by a red candle that engulfed all the price and even went down. So this is a bearish engulfing. You can see here, this is like a doji, very small body, wick up and down. The market continue in the direction. You can see it's everywhere. Okay, let's move like, okay, someone asked about gold. Let's move to gold. You can see here the same patterns. You see here, you see this is a doji. This is a very, very small candle with this is 1 day candle. Okay, so during the whole day, the open price, close price, high, low were in a very small area. So this will mean that the trend will continue. So the trend actually continued, as you see here. For some time, when you can see, this is doji giving you indecision, and if you can see the next day and the day after that, the market was not moving up or down. So doji actually giving you that the market is not in the direction strongly. So if there is no more question, I will end this session right now. Okay, seems like everything is fine. Please feel free to send us if you have any question. You will receive an email after this webinar. Also, you'll have a recording of the session on our website and our YouTube channel. We always make these webinars at Thursday, 6 p.m. Dubai time. So please join us on the upcoming webinar next Thursday. If there is no more question, I will end this session. Okay, thank you for your time and see you soon. I will end this session now. Goodbye.